If you invest in stocks, crypto, or real estate in the United States, there's one thing that can quietly take a big portion of your profits: capital gains tax. And the surprising part is that many investors only think about taxes after they've already sold their investments. By then, it's too late to optimize. In this video, I'm going to clearly explain how capital gains tax works in the United States, the difference between short-term and long-term gains, how much investors typically pay, and most importantly, a few practical strategies many smart investors use to legally reduce their tax burden. First, let's start with the basics. Capital gains tax is the tax you pay when you sell an asset for more than what you originally paid for it. That asset could be stocks, ETFs, cryptocurrencies, real estate, or even certain collectibles. The profit you make from selling that asset is called a capital gain, and that gain may be taxable depending on several factors. Let's use a simple example. Imagine you buy shares of a company for $5,000. A year later, those shares grow in value and you sell them for $8,000. Your profit is $3,000. That $3,000 is considered a capital gain, and the IRS may require you to pay tax on that amount. However, the amount of tax you pay depends heavily on how long you held the investment before selling it. This is where the concept of short-term and long-term capital gains becomes extremely important. If you hold an investment for 1 year or less, the profit is considered a short-term capital gain. Short-term gains are taxed at the same rate as your ordinary income. That means if you're in the 22%, 24%, or even 32% federal income tax bracket, your short-term investment profits could be taxed at that same rate. Now, compare that with long-term capital gains. If you hold an investment for more than 1 year, it qualifies for long-term capital gains rates, which are usually much lower. In the United States, long-term capital gains are typically taxed at 0%, 15%, or 20% depending on your income level. For many investors, this difference can be huge. Imagine two investors who both make a $10,000 profit. One sells after 10 months and pays a 24% tax rate, while the other waits just 2 more months, qualifies for long-term treatment, and pays only 15%. That small timing difference could save nearly $900 in taxes. This is one reason why many experienced investors focus on long-term investing strategies rather than constant trading. Now let's talk about something many new investors misunderstand. You don't pay capital gains tax until you actually sell the asset. If your stock goes up in value but you haven't sold it yet, that gain is considered an unrealized gain and it usually isn't taxed yet. Taxes generally apply only when gains become realized, meaning you've sold the asset and locked in the profit. Another important concept investors should know is capital loss offsetting. Sometimes investments don't go as planned and you might sell something at a loss. The good news is that these losses can sometimes help reduce your tax bill. For example, if you made $5,000 profit on one investment but lost $2,000 on another, your net taxable capital gain would be $3,000. Investors often use this strategy, called tax loss harvesting, to manage their taxable gains more efficiently. In some cases, if your total capital losses exceed your gains, the IRS even allows you to deduct up to $3,000 per year against regular income, with additional losses carried forward to future years. Another thing U.S. investors should understand is that capital gains tax can exist at both the federal and state level. Federal tax rates are consistent nationwide, but some states also apply their own state capital gains taxes. For example, states like California may have additional state-level taxation, while states like Florida or Texas do not have state income tax, which can impact overall investment taxation. Now let's talk about a few legal strategies many investors use to reduce capital gains taxes. One strategy involves holding investments longer than 1 year to qualify for long-term capital gains rates. Another involves investing through tax-advantaged accounts like retirement accounts, where gains may grow tax-deferred or even tax-free depending on the account structure. Many investors also plan their asset sales carefully based on their income level for the year. Since long-term capital gains rates depend on taxable income, selling assets in a lower income year can sometimes reduce taxes significantly.